So incorporating means you're actually setting up a separate legal liability under law. Now that can be under provincial or federal law, but generally it means you're setting up a separate entity that's separate from you as an individual. Practitioners or proprietors, if they're looking to do so and set a corporation up for their business, it sometimes can make sense to do, like we're going to talk about, to do that for reasons for liability and taxes. And effectively what that means is they're separating themselves personally from operating that business into another entity, the corporation, that will operate and own that business. They become owners then of that corporation. Going back to liability, that's usually the biggest thing. As a separate legal entity, a corporation is detached from the individual owner. So this means that your personal assets are protected from the corporation's liabilities and that business risk, because now that business is operating inside of a corporation. So we refer to this as the corporate veil. And it's usually the main reason why business owners kind of gravitate to using a corporation to operate their businesses. And I should also note that sometimes, not all liabilities can get protected from that corporate veil. So some things like GST, payroll withholdings, or even certain professional liabilities can leak through and point up towards that individual owner of the corporation. Having a corporation still should afford you some benefits and protection in that regard, as opposed to having none by operating as a proprietor. Anytime we look at tax benefits, we're always talking about two things: tax deferral and tax reduction. And with a corporation, both of these are possible. So generally, most of our tax rules in Canada are designed to help promote and encourage the use of corporations. And what I mean by that is there are a lot of advantages and potential planning opportunities afforded to corporations that aren't available to other entities like individual proprietors or partnerships. So assuming you're a Canadian resident and let's say you have some active business in Canada, and usually the most popular benefit by using a corporation to run your business would be to get access to something like the small business deduction. So in Ontario, that means that you would be taxed inside your corporation on your business income at a rate of about 12% on your first $500,000 of taxable income. So that's income. So revenue minus expenses, not just your revenue, income. And that's a huge advantage over somebody who's not incorporated with their business, because they'd be paying tax at their regular personal rate, which in Ontario is in the top rate of 53.5% when you get up there. So even going back to that idea, if you're making more than $500,000 of income inside of a corporation or don't have access to your small business deduction, you can still get an advantage on the tax rate, because the rate would be 26.5%, which is still significantly less. So when we're talking about tax rates on business income, that's a tax deferral of about 27 to just over 40% by using a corporation for your business. And with the right planning, we could also probably tap into making those tax deferrals into absolute tax savings, if it makes sense for you, once you personally withdraw that income from the corporation. For sure. So going back to tax deferrals, when we're talking about paying a lower rate of tax inside your corporation, that means you have more money available inside your corporation to expand the business. And the policy design behind those rules is that the government is trying to encourage economic growth, and economic growth through the acquisition of more equipment and services, facilities for sure, but also hiring employees. So when you're hiring employees and you have more need for help and labor to grow and operate your business, having more cash available is key, and for sure is going to go a long way to helping you hire people because you have more money to do so. Another advantage by having a corporation with employees is, while you have, call it, certain benefits, and the greatest example is the car, and that's the most popular example, where you have an employer provided car. The company buys a car and the individual uses it personally. Well, In that scenario, you get the benefit of using corporate funds, which you have more of because you paid less tax. So you can buy a car and operate the car, and then you can drive it personally. Now, the advantage you have there is that you only have to pay tax on the value of that benefit. You don't actually have to shell out cash to pay for those expenses. You just have to come up with the cash to pay for the value of, pay for the tax on the value of that benefit. So again, your money goes a longer way for things like benefits when you're pushing those through to employees and doing so through a corporation. There are definite disadvantages, and I think the biggest one is probably the cost. Setting it up can be expensive, at least relatively speaking, especially if you're a new business. Individuals don't always seem to like the idea of spending more money when they maybe have limited resources to do so while they're setting up their business. But again, that discussion of pros and cons and advantages versus disadvantages, and where are you most better off or better served under what sort of structure is going to drive that decision making. So the administrative cost of the setup, as well as the ongoing administrative costs of operating and maintaining a structure or a corporation as you move forward, because things like bank accounts and a separate set of records and corporate minute books and that type of administration is a burden for sure, but hopefully the benefits outweigh significantly the cost of doing so. So that's a great question. So if you are a shareholder of a corporation, as you understand, there is a separation between the individual and that corporation. So when you die, your corporation continues to live. And effectively what happens to you as an individual is, along with your other assets, you're deemed to have disposed of the shares that you own when you die. So there's going to be a tax consequence to that when you die, and there's planning involved, and you need to get updating of your wills and things like estate planning, depending on if there's any values that need to deal with. At the same time, your corporation or business inside the corporation will continue to live. So depending on what you've set up and planned for, those shares will usually transfer to a family member and or potentially even employees of the business. So there's a continuity of that corporation after you die so that it continues to live. And again, that speaks to that separation of the two entities in law. Yeah, definitely. And in dealing with professionals, usually those concerns or issues are dealt with by the governing body who issues your license or affords you that ability to be a practitioner in the marketplace. So there could be restrictions with respect to the extent of your liabilities through your corporation. Sometimes that could impact your insurance or the type of arrangement you need to set up with your insurance provider. That could also affect who might be able to be a shareholder of that particular corporation, whether or not a holding corporation can be used. So there could be a lot of those types of issues that need to be addressed and looked at. And it's not just a vanilla run-of-the-mill, a corporation is a corporation for any type of business or individual looking to incorporate. So yeah, that's a definite concern and something that needs to be looked at to see whether or not it actually makes sense for you to even consider going down the incorporation route.